Hi there, this is the workflow guide for the Durrett LLM agent that I published just yesterday. In this guide, I'm going to walk you through how to interpret the open source code that's there and make changes to suit your liking. I'm going to take you through a couple of different platforms and show you some of the variants of what comes out and how to bed in your own style in some of these language model platforms so that you're getting relatively consistently the same results from company to company. And then we'll look at some of the follow-up questions you can use to interact. And this is where the power of the tool really takes shape. I'll walk you through the formula libraries that are built in and how you can leverage, other kinds of valuation, other kinds of projection that suit you. So let's dive in. All right, well, let's kick off a demo. I've added in the agent here into context window. This is Perplexity. This is actually Comet, their own browser. And I'm going to use research mode, and I'm in incognito just because I ran this query yesterday and I think I will have better results not running the same query twice. We'll get to that in a moment. We're going to evaluate Equinox. Sometimes I just like to put extra in here. Let's kick this off. We can talk about what's happening. So at this moment, it's initiating a workflow. We see our agent right at the top, so that's good. So let this go. It'll flip it back over to the agent code. So if you come up in the plain text, everything you see here in the top, well, between these three dashes at the top and what is now line 167, this is all YAML, which stands for YAML ain't markup language, I believe. So this is all just the pseudocode that the models deem most important. That's just the best way I know how to describe it. So YAML's a subset of JSON. It recognizes this very, very specific indentation, very specific formatting, and takes the text that it finds here in the YAML as its primary operation. So I'll let you just browse through it your own, but we're doing the template of this prompt is going to be evaluated mining stock ticker, etc. So our workflow has these steps. We're going to research. We're going to go. First of all, we're going to find out what is the complete project size of the company. We're going to go get the 43101 reports where we can find them. Interestingly enough, the SEC and SATR in Canada have throttling limitations, and so we had to engineer around that. So it goes on those sites to find the names of the reports, and then it should go back to the company website to actually pull the technical report documents. You will see that audit trail in the output, but everything that's coming that's in this context window is going to be still running. So we're still running. Everything that's being staged back here in the background is going to include, for Equinox, it's going to include about 8 technical reports. It's only going to grab the latest one. So it's kind of complex there. That was the big data scribbing event. So then we're going to do some cross-referencing to make sure they have the right numbers. We're going to do the validation. And then we're going to start computing some of the calculations and some reasoning and put our chart widget up and the 10-factor analysis and so forth and so on. So that's all defined here in this messages, these steps. So I have the workflow, then I have each step, and then you go, all the way down to validation rules, primary sources, error handling, etc. So this is just the complex wrapper that's enforcing the discipline around what the model does. So it doesn't give it a lot of leeway, as it were. So a couple of points here. I'm telling all these guys to run under determinism. Deterministic equals true. By nature, Gen AI and language models run as stochastic equals true. That gives them more creativity. They run with a temperature value of, I don't know, 30% or so. We're running at 0. So if you want to increase your creativity, you can stay deterministic and bump up the temperature. The random seed is supposed to enforce repeatability. I can't guarantee if that's true. Telling we're definitely doing the workflow. We're running in Sonnet 3.5, Claude 3.5. If that's available, that's the preferred model. The analysis just looks better out of that model. And, you can dive into, go through the different points here. I had to insert this line 7 in our data scraping of the 43101 reports because the model wouldn't run for exploration companies. It required to find an NI 43101. So I thought that was reassuring, but we still wanted to run our take factor analysis. So in this case, if it does not find those reports, it will let you know, hey, this is we kind of had to use some estimates. It should tell you where it got those estimates on the resource size. Okay. On to the actual markdown. So in the markdown, this is all plain text. One of the points for the open source approach is to give you guys a chance to just be able to read everything and change what you like and make your own version of this. Premium one I'm working on, it's all going to be workflow microservice driven like you see up here, but I'm going to hard code things in hard code. I'm going to build it in Python so that it runs faster. That'll run some, 10 to 30 times faster, hopefully. Sorry, lost my place, but I kept everything plain text just so that you guys can see what's going on. So here we have, right after the usage guidelines, we jump right into the 10 factors. This is the chapter 10 stuff from How to Invest in Gold and Silver. I went through each one of these categories manually, cross-referenced the book with here, and then I just took the best guess of what I thought would be the right enumeration rules. Okay, very subjective, but this is the most subjective part. I found that I got much closer than the original to some of the ratings on gold stock data. And so use it at your own risk and do your own level of scoring. Everybody's got their own way. This is just a starting point. I think we were experiencing more range now than the original. So they're all there. You can just clearly see scoring. 9 to 10 means this, 7 to 8 means that. And you can figure out how to make those changes or improvements as you like. Okay, so then we get into the Durrett definitions and reference standards. So all of these formulas you'll find in the book. I'm sure there's a formula in the book somewhere that's not here, but I'm not aware of one. So let me know if you find one that's not there, that's not represented. But first of all, we start with our constants. These constants at the top, these are our resource weights. They're pretty significant to any valuation you do because we're assuming, these are the data quality weights up here. Not as important. The resource weights here, Durrett constants, very important because we're going to be using a plausible resource value to do all of our quick, dirty valuation. That's how Don does it in the book. That's how he does it on the website. So we start with proven improbable of 1, measured and indicated of 0.75, and inferred of 0.5. That's what the book says. Don doesn't always do that on the website, I have found. And he has his reasons, but this is a starting point. So if you find that you like different weights, feel free to change them here. This is where you would do that. And if you find that you want to change the weights for a particular company for various reasons, and you'll see everything laid out in the report, you'll just simply tell the model to, hey, change the weights. Give me a 0.8 recoverability rate on provable and improbable. That is the beauty of large language models. So But that's there, and we're trying to stay as close as we can to the textbook, not necessarily real world, but keep that in mind when you look at results. Okay. So then our measured and indicated, also important note, our measured and indicated is exclusive of proven and probable. Okay. When it does the sourcing from the geology reports, it knows how to interpret all the different ways the geologists give it. That's part of the magic of that scrubbing step. And so far, I have not seen it make a mistake. I have seen it not include all of the resources because it doesn't see all of the projects. So that's something to keep an eye out for. It may be that, well, in most cases, not every project necessarily has a technical report out on it. So what it should do is loop back and check for the totals, as in total, inferred. So usually if it's off, it'll be on the inferred side, but it's typically incompleteness. If you get it, always check your resource size. Always check your total shares outstanding if you're going to use the valuation number. We'll take a look at that when we see the report. But those are our key numbers that tell us, this is an 8-bagger or whatever. Very, very important. It'll be very obvious. Every time I ask the model, hey, this looks low, this looks high, it self-corrects almost the next time out. So very cool. All right. So these are all definitions. I'm not going to go through all these, but suffice to say, fully diluted shares equals, we're including our warrants, we're including our convertible stock, all of that stuff. You'll go through here. Everything is defined as an official formula so that if I go back to free cash flow, I'm talking about something very specific. That was something I coded in here just to make sure for consistency. So far, it's working great. We've got a little net present value formula. So net present value is not in the stock output, but if you want to call a net present value of an individual asset, you can do that, an individual project. You'll give it a discount rate. And so then there's some logic that we determine whether it's a gold project or a silver project. So it uses the priority of gold, silver, and lesser base metals and so on to determine that. So that's all. This is actually JavaScript that it's function, but it's just using that to define it in that format. Just kind of scale through here. Discount rates by stage. So under the covers here, we've got, if you look at the sum of the parts model, you'll see analysts often will take their NPV, net present value, and multiply times 0.3. So let's say if there's a high cost of capital to get a project online, say in the discovery phase or in the pre-feasibility phase or what have you. So there's some factors in here. Those aren't being used, but they're there for the taking, and they're there to be recoded. You've got NAV multiples by stage. These discount rates would be your interest rates. A lot of stuff I'm not using. There's a reason why, but there's a lot of stuff you can do with this model. Here's the jurisdictional tiers. Don's, when he refers to tier 1, etc., he's saying something different than, say, like someone like Rick Rule. Tier 1 is simply the jurisdiction. Rick Rule's got rules about the tier being, how much in the ground, relative, the grades and so forth. So let's see. We've got padding. So it's going to use some judgment to pad the ASIC. So there, you'll know from the book that ASIC that's reported is light. It does not include oftentimes the debt and overhead expenses and various other things they don't have to report. So Don as a proxy uses a pad. We start with a base, and then we add more if it's a junior, and we add more than that if it's a developer, and so on and so forth. It's going to do this, and it's going to show you what it did. You'll see in the results. You can change the pad if you like. You can just change the adjusted ASIC if you like. So that's a key number, right? When Dodd does one of these interviews, he refers often to his all-in costs or adjusted ASIC. Let's see. Okay. I think there's anything else I want to. Got some validation logic, just black box stuff, really. Okay, so execution framework. This is kind of a repeat of what I have in the YAML. I didn't take it out because I didn't want to retest everything. Probably doesn't have to be there, but it seemed to enforce that we're getting the correct output. I've got a report template, so this would be a few shot example of what I want the model to complete with real, dollars and cents and words in it. Few shot in large language models just refers to, if you can't define it in an abstract terms, just give it a couple examples and we'll figure out what the abstract definition you're looking for. That's called few shotting. So we got a single shot, I guess. And then I have the output specifications here. We got our company ticker symbol. Everything you kind of see here is what we should see in the results. And I'm not going to bore you with all of these details because we're going to look directly at the results. But you can see if you want to move things around or even add stuff to this mandatory output, you can. In fact, you don't even have to put it here. As you use the model, if you just start asking for extra things, it will assume that you want those every time. That's what we're going to talk about next. Okay, so let's take a look at the actual output now that it's done. So we evaluated Equinox. Let's see if it got it right. I did this in real time, no cuts. We've got a data quality score, 88% primary sources. A primary source is going to be SEC, so you're going to be your financials and your 43101 documents, which is primarily the data that we use for this analysis. We've got our overall score of 7.2. Yeah. So Don's score is 7.2. Okay, that's purely by accident. And if we look at any of the details, we'll see that there's movement. But to suffice it to say, the variance has gotten much tighter. I think it's because I went in and defined very specifically this deserves 2 stars or whatever. So let's get down to it. That's today's price of gold. Can you believe it? It's the reported ASIC. That's a couple years old. And then we've got all the projects for Equinox. How long the mine life is, years production, and where in the Lucene curve the project is. I do want to invent a widget that will clearly show that. I played around with it. None of them look good, so they're out. But I wanted the investor to see kind of what the pipeline, just visually. I want this to look kind of like simply Wall Street, but just for very focused, detailed stuff. So let's get down to our reserves and resources. Here's today's prices. Those are correct. Proven improbable 23 indicated. Okay, this is not correct. Typically gets this correct. Perfectly good, because I'm going to show you how to course correct it. Yeah, we're looking for Don's website has measured and indicated as inclusive of proven improbable, which is common. So it's going to be 22. So it's going to be 23, 22, and 14 are the right answers. And we got 23, 8.6. So this one's right. This one should be 22 and 14. So it left some projects off. I'm going to make a note. Let's check our shares. 839 million. That sounds right. 839 million. Okay, so I know that any kind of price recommendations that it's going to make later on, because we have understated the asset size and the project size, that we're going to understate any sort of upside potential. That's okay. We're going to overstate the EV per plausible ounce. So this number should be somewhere south of 250. Here we've got an ASIC with padding. So we did a 25% padding on an 1850. So they Don has like 2500 for Equinox. That is because this number is fairly old. This is something that if you're going to get really serious about, how much upside you have, this is something you might want to go back and talk to the model a little bit about and play with, because this number, just like the top side number of the price of gold, this number is very important. It can move almost as much as the top side number. So pay close attention to what it gives you, and then correct. So here's our formula for plausible. We've got the 1 and the 0.75 and the 5. That is the correct application. Here's our options, warrants, and convertible securities to get fully diluted. And our source documentation. And all of our scoring. I think cost structure is the low number, and share structure. There was a big dilution event. So you get a radar chart, or you should get a radar chart. I don't know. I just thought it looked cool. There's a little Python code that'll do that. Probably not necessary, doesn't add a lot, but just looks cool. And then under the wrong assumptions, now we have 1.61 billion free cash flow. That gives us a 15 multiple of 2882, which is still a 137 upside. So let's go ahead. It's giving us a buy and everything. We'll say on the reserves and sources numbers look understated. Okay, before I'm going to hit that question, that follow-up question, but I'm going to go ahead and give it a thumbs up. So if the format's what you like, tell it that. You're training this model to provide you with a specific pattern. Always give it a like or dislike. You're in the process. This is the bedding in process of using the model. So go ahead and go, followed instructions, etc. Okay. Let's fire up the follow-up question. Let it get going. It's going to start off a new workflow. So I've got, in a way, there's no reason to score sycophancy because I'm building in this workflow. I am saying what are my red flags? What are we not telling? What is the narrative not telling me? And so I'm having it comment on any place where the stars are low in the 10 factor here. So you got on your red flags. We've got cost structure, and then the details of why it scored those low. And then, we've got high debt at the moment. So these are things need to be aware of, geopolitical. Okay, so here's our audit trail in Perplexity. I like Perplexity a lot because I have all the links. Now it is going to point me back to the company website, but it's the company website that has the copies of the tech report. So if I see the NI 43101 right there, boom, I'll open them up. And keep in mind, all of these reports, there's going to be like 80 something things in this context. This is a 500-page report, and I've got a whole bunch of them in the background of this context window. You're going to see we can ask all kinds of questions about the details in these reports. That's where this thing really makes a buck. So for some reason it used Claude Sonnet 4. The results look fine. Don't care too much. Lot of tokens. 90,000 is a lot of tokens. That's about a 75-cent run on the API. We're still running down here. So you would have to, most of these, any of the free options on LLMs, you're not going to get a 90 token context window. It's just not going to give you that for free. You're going to have an upgraded account. Just keep that in mind. You're going to get some sort of truncated version. That's typically where the resource estimates are on the low side, is when it just runs out of space. And frankly, that's probably what happened here too. Equinox is a big company. The The majors, you probably aren't going to do this with many of the majors. The whole point of this exercise is to attack the juniors, to attack the micro companies and in the near term producers and so on, the small guys. Two projects, get after those guys. So Equinox, I just chose it to demonstrate volume in this case. So let's go, while we're waiting on that, let me show you sources. So it actually pulled 111. So 90% sure we blew up our memory on this in this context window, and that's why it truncated the reserves and resources numbers. But it's going to correct that in its current query. So let's all this stuff. So, and then if I look at my steps, this workflow should be somewhat similar to what we saw in the YAML in the agent. It's going to go through long thing. You can kind of eyeball it. Wrote some Python to create this chart, so forth. Okay. See if we're done. We're done. Okay, let's see what it responded with. Corrected analysis. You're absolutely, as a user in language models, you're always right. You'll notice that. Always right. So yes, 46.2. I want to point out another detail. So if you guys came for no details, then sorry. It's important that we, we're working with some novel technology here. It's important that we develop a certain degree of credibility and trust. Okay, so you're going to see goal stock data has 40.46. We have 46.2. Not bad, not bad. It's actually better than it looks. So in our gross numbers, we're actually exactly right. Don has some different recoverability factors for Equinox. They just are what they are. So you could change that if you wanted to. You could. He's got less than, I think he's got 0.8 for prove it improbable, and then we kind of look the same. They're a little bit lower on measured, indicated, and inferred, but for whatever reason has lower. So he's got a 40-46. So you're going to see slightly lower projected number for him. Let's see, ounces per share. Okay. Yeah, so we went 23, 22, 14. There they are, 23, 22, 14. Remember, we're inclusive. 23 plus 22 is 45. For a total resource base, get up here, of 59. He has 59. We got 58.5. Nailed it. Okay, so here's our plausible formula. And market cap per research ounce. So this is based on plausible. So we're $200 per ounce of gold in the ground. Don is at, drum roll, 288, but that's because he's using 46 number. So as long as we just understand those are the reasons why, no problem. We're saying Equinox is favorable relative to Barrick and Newmont. It has a mid-tier producer range. I think the answers are answered up there in the red flags. I'll let you guys do your own research on that. And so we have we revised the properties and ownership upwards, both of these. And so now our revised numbers is 7.6 and a strong buy. I'm not going to go through it in this example, but if you use Claude, the actual Anthropic front end, it will edit the original document right in front of you. It's really cool. I really like Anthropic. I'm not a paying member there, but Perplexity, Anthropic, I don't know. I like them better than OpenAI. Let's see. Why it matters. Free cash flow. So now on a free cash flow basis, we have a 1282. We're still seeing that 1282. Oh yeah, because that's our margins. Don has an adjusted ASIC of 2550. Noted he adjusted that up a couple of months ago. based on the cash costs going up. So that's only $200, and I think we're probably reflecting early in the summer unadjusted ASIC. Oops. Let's get you here back to our research report. Yeah, Don's adjusted ASIC 2312. So that just reflects an upward adjustment. I think he has it in the notes, in his notes. But let's see. Rework free cash flow calc with adjusted. This is a that's a reserved formula word, by the way. Adjusted ASIC of 2550. That shouldn't take very long. Kick that off. All right, and it gave me a result. Now this is really cool. It gives me kind of a sensitivity. So here's the company reported cash cost, original adjusted ASIC, and then the new one. And I point out right here, guys, I've spent most of my time just testing this, that we're sourcing correctly and that we're not hallucinating, doing crazy stuff. Now that we have a foundation and everything's in this context window, I can really interrogate this company. I haven't even done that because I have been just trying to get the foundation of this guy poured, but I'm interested to see what you guys can come up with. But just by asking the question, it assumed I wanted some sensitivities, did a revised calculation. Now we're at a free cash flow of 1.4. That reduced us by 12%, so it's going to cut my valuation down a smidge to $25. It's still a double. Of course, we can do the gold sensitivities here at this point. I highly suggest you do that to get an understanding, especially if you maybe have an intuition that gold might be doing a strong pullback at some point. This guy's made, this is where we are on the market. We're not trying to find deals. We're trying to think about, okay, where are we relative to fair value after such a strong move lately? So we've got padding, investment thesis intact, break evens. I do like to look at optionality. So we're still saying at 3,000. ASIC is strong. Okay. All right. Let's see. What else can we do? Okay. Let's fire this guy off. Okay. So let's take one of their producers, Fazenda. Let's go on to 2033. It's kind of a random one. It's not the biggest, not the smallest, right? Okay. Calculate an NPV at current gold prices for paste at discount rate of 8%. Assume the remaining mine life from the 43-101 report and consistent production at current rate. Okay. Probably not accurate, but I'm using a lot of conservatism at 8%. So let's just get, what is the value of that one project? Why would you want to do this? Well, if say Newmont, when they get to sell their next tier 2 asset and they're going to get however many bucks for it, you can go do this calculation. Just start where we started here, do the full Newmont. You'll know exactly any of this. A lot of times there's dilution to help build something in developer state. We can find out within this very model, we can determine what the value of that dilution was. So if, let's say you got a 30% dilution, but it allows a company to build a $300 million mine, which is accretive on a net basis. You can determine all these things inside of this calculation. You've got your own little credit quant analyst here to do all the work for you. So I'm going to hit the pause button. And now, it's still running the workflow. So here's our projection. It's a CSV. It doesn't do Excel natively, but here's our projection. We've got, operating costs, ASIC, revenue, sustaining CapEx, free cash flow, discount. Wow. It's not going to mean a lot to me at this moment, but so it's saying that particular asset, the Fazenda mine, at 8% is worth 1.5 billion, 1.05 billion at current gold prices. It should have had some numbers in the economic studies and the feasibility studies that you can compare to. So it gives us. At some point, we probably have to project higher costs underneath, assuming inflation's and energy costs are going to go up. 8% is probably not even enough to accommodate that, but here you have payback period 4.3 years. So if there's an M&A situation going on, there are going to be, one or two key assets of a company. Now I know if the M&A, somebody pays $2 billion for this, now I kind of can do the quick work from my existing workflow. And granted, retail individual investors have not done this they don't do in the past. We haven't done this kind of stuff. This is what's crazy, is that we can do this kind of stuff. Now you need to learn what questions to ask, how to read the reports. If you don't know, ask it. Let's see if there's anything. Here's sensitivities on this asset. Just sensitivities with ASIC. This is the kind of stuff, this is the kind of draft level stuff I would expect if there's some, board meetings to sort of cut up an asset loose, or this is the kind of work that some companies probably doing and used to do in weeks or months for M&A, and now we've got it on the fly, Investment implications. So the Fazenda net present value calculation demonstrates that Equinox Gold's individual assets are significantly undervalued relative to the company's market capitalization. Okay, I'm probably going to break something. The last thing, please perform net present value calculation on all the reported assets at the discount rate that is appropriate for their stage of the company life cycle. So let me define that. Okay, so it's going to be NAV discounts. And stage name is my function input. Yo, let's get on out of here. Okay, so at the, let's use NAV discounts relative to the appropriate stage. Is that what we have? Stage name. Okay, assume a recoverability rate of 80% proven and probable, 75% measured and indicated, and 50% inferred. Cross your fingers. Let's see what happens. All right, so I'm going to shift gears while I'm waiting for this to run and show you what Grok did. Grok is, I'm using my, check mark membership with Grok, with X. So it does give you some Grok capabilities, but not the top line. Those of you who are paying more, those of you creators and stuff, you're probably going to be able to do these other models. Expert thinks hard. I think everybody who's got like the check mark version is going to be able to do an expert like one time. So you'll decide how you want to do that. But I was pretty impressed with Grok. Just to kind of go through here, it is very, very, very similar. Reserves and resources, I actually got it right. And let's see, it used less padding. It just chose to do that. And then here's my source documents Just look at that. Many of these documents are 500 pages. How long would it take you to go through these? It's mind-blowing. Okay, so we're a 7.5. Very, very reasonable. Radar chart. So for some reason it produces some plain text. Don't know why. Implied upside 200%. This is all very reasonable conclusions. Grok used only 5,000 tokens, whereas I had 90-something thousand over on Perplexity. Just something to keep in mind if you're a Grok user. Maybe not all the bells and whistles, but I think maybe that radar chart's kind of expensive on a tokenized basis. But here we should be able to do, let's go ask our question. Let's ask a follow-up question for Grok. Let's see. Let's do the same net present value. It should all have the information to do that. So away we go. Let's see, Gemini also had the same prompt here. I like the look of Gemini. Nice formatting. This was all pretty tight. Understated reserves of resources. 90% sure that's because Gemini did not give me the tokens to catch them all. It should be circling back and hole filling. Yeah, we used 3850. So I bet you that's the reason why. Most of the time you're going to get completeness there. I told it, wait a second, Grok. Wait a second, Gemini. This isn't the current gold prices. Oh, you're right. So then it fixes all that. And it said, I don't have all of the data. Is this the whole reserves and resources? I said, oh, yeah, you're right. We missed all these. And then finally we get down to it. So I could keep going. This padding looks weird, whatever. You all know this isn't an investment advice that do your due diligence and check these calculations. Okay. Let's see. We're still going there. And let's take a look at, let's blow it up, right? Okay, so comprehensive NAV analysis. Have no idea. It says NAV per share is 9.24. I have no idea if that's right. No idea. Because can't see all the details. We're summing every single project. Doing an evaluation of every single project, summing them all up at 8% discount. Actually, no. At the discount rate assigned in a model. There's our stage-based discount rates. Those look right. Let's see what it applied. There we go. So Greenstone, the top one, we got an 8%. It's in production or ramping up. Golden Eagle, resource expansion, 15%. Legit. Let's see. So here's our individual net present value. So if you're reading one of the Sprott Capital Partners reports, you're going to see individual net present values of each project. Again, this is going to work a lot better on single mines and juniors and stuff. This is how you would approach it, but what the heck? Okay, so producing assets. Here we got 7% discount. Probably could use 5. I mean, it's Brazil, so maybe jurisdiction's not as good. And so we see much higher net present value per ounce. That makes sense if we're reducing. And so this would be our explorations. So obviously these are cheaper. We're using a higher discount rate. Man. You guys saw me do this, right? You saw me do that. I did this in real time. This is scratching the surface. You guys let me know what you learn and what you find out. I mean, because we're all just kind of novel technology. We're all learning it here. Here it said to use the 80, 70, 50 I gave it. So you guys want to have a different method. So Grok said the net present value of our mine was about right. 1.05 billion, right on the money. Okay, so let's wrap it up. Let's wrap it up here. So do this, guys. When you've got the agent in the model list and define all of the, now let's see, list, define all of the functions and formulas in this agent and provide comments. Let's get a brief explanation. I can spell. Okay. All right, so it's coming back to us. So here's a comprehensive list. So if you have no idea what I just did, hopefully you're still watching, right? If you have no idea what I just did, ask this model. Have it teach you. This is what's amazing. You essentially have a good portion of Don's book, and you can ask it and just say, show me why did we do that? Why did we use a 15 multiple? It's arbitrary. That's why we did. Maybe you're using a 10 multiple of cash flow. What is free cash flow? Ask it here. It knows Ben Graham. It knows everything in here. Ask your model. So if you have like deeper questions on any one of these, ask for an explanation. This is going to teach you how to be a better manager of your own stock ownership, right? So let's see. Just kind of scan through here real quick. We have some constants. All these functions, they're just back there. You know, you can go add functions if you think we need something else. I think anything that's a standard finance formula, it knows how to do, right? So yeah, so leave me comments, send me a note on Substack, subscribe to my Substack. This won't be the last model I'm going to do. I've got big plans to stitch together a number of microservice agents. They're probably going to be under premium. I spent a lot of time testing this model. I have something like 100 hours of testing in it. I wanted to kind of give something back to the community. You know, Don's been very generous with all of his picks and his interviews, and so I want to kind of give him a shout. Join Gold Stock Data, subscribe to my site if you're not already. It's worth every penny. This is a supplement to that site. It does not replace it one bit. It just gives you the ability to have logical interaction with all of the data that's out there. So much more to come. Follow me, stay with me, and we're going to go make some money. All right, guys, see you on the next video.